should one invest in commodities to diversify his or her portfolio? What are the advantages of investing in commodities? And help us understand, does it really act as a good hedge against inflation and other political uncertainties?
Shesha, what happens is one invest in commodities depends on their current status. Okay, what is their other alternative? See, basically there are four assets which have stood the test of time. One is equity, the other and is real estate. These are two growth assets. And debt and commodities can be a protection asset. They can help you reduce your risk. Real estate and equity can give you the upsides. So point one I'm trying to make is whether you're going to be investing or not is going to depend on whether you're using it for what purpose. That's point one. Point two, commodities have to be invested. If you want to invest in commodity from a hedge perspective or a diversification perspective, you have to first understand there are 2-3 levels of commodities. Because commodity is a very large umbrella. You can have agri-commodities, you can have bullion. So what you have to do is you have to first categorize them into 3 different heads. Bullion commodities, which are metals, bullion energy, and the last one is agri-commodities, which are also called soft commodities. So I would say you should not get into soft commodities or energy commodities, but you should begin with metal, which is more tangible and more comprehensible. Is the point I would like to make.
But Feroz, coming back to you, let's talk about gold in particular. Say if I want to invest in gold, which instrument would you prefer personally for investments in gold?
Yes, if you're looking at commodities and if you're looking at metals and if you want to restrict your usage to gold, which is what I personally recommend, because silver is also a very sporadic commodity. There have been 10 years of silver giving no return in rupee terms. That has not happened with gold. So gold is a more predictable commodity. Now, if I have to first start with gold, and if I have to answer your question of which is the more cost efficient and effective measure, effective platform to participate in gold, I would say if it's a short term, then you should look at gold ETF. If it is long term, you should look at sovereign gold bonds in the secondary market because the primary issuances don't seem to be coming anytime soon. That's from a gold standpoint. Especially after the budget which just went by, the maiden budget of the third term of the Modi government, they have reduced the tax implication on ETFs and fund of funds. So gold funds and ETFs, taxation has become better, which is 12.5% long term. Having said which, so ETFs are very cost effective, both on the cost of the management and the tax cost as well. So that's what I think one should focus on. Because if you look at the efficiency ratios of different commodities, if you look at gold, gold has given a 10.8% return on a 3-year rolling basis. And the risk it has thrown up in standard deviation is 5.5. So if you divide return by risk, which is where efficiency lies, gold is the best commodity in terms of efficiency, but still worse off than equity. The efficiency ratio of equity on a 3-year rolling basis is 2.5 and of gold is 1.98.
Well, absolutely. And also wanted to understand what are the main drivers that drive prices of commodities? How do demand supply dynamics and geopolitical factors impact commodity market? Feroz, this question is for you.
The commodity market have different variables and different commodities have a different demand and supply mechanism. Commodities also go through paradigm shifts. See, that's why it's a little more complex instrument. See, equities are more correlated. If the top 50 stocks of Nifty today are up today, it's quite likely that the next 50 are also up today. But that's not true with commodities. They can move in opposite directions to each other, significantly opposite directions. So that's one. So to answer this question, you have to first decipher which commodity are we speaking about. Now, if I look at commodities in general, they, of course, geopolitical uncertainties can have a different impact on gold, especially when sovereign countries are collecting gold, left, right, center. But the usage of gold from an ornamental standpoint is going down. India has been the largest consumer of gold in the world from 1990, if I'm not wrong. And now India's consumption pattern is changing. Diamonds, for example, if I count them as commodities, not so well traded. on the exchanges, of course, not traded on the exchanges, but they're transparent commodities, have gone through a paradigm shift after lab-grown diamonds have come. So point I'm trying to make is, first choose the commodity you're trying to understand the forces of. Every commodity has different forces, point one. Point two, commodity usage and the paradigm shifts in the usage is far more important for a long-term investor. And I think gold ornamental value is coming down, but because of the kind of uncertainty and the global political uncertainty, especially, and the war situations which we have seen time and again from Ukraine and Russia to the unsettled Middle East today, I think gold has a larger preference from a government sovereign perspective. So that's one thing which I think has the largest impact on commodity.
If we go by the last 5, 10 or 20-year returns, gold has clearly given aggregate lower returns as compared to Nifty. So then why would one want to invest in commodities? Do hedging benefits actually overweigh lower returns from equities? Does it make sense to invest in commodities as a hedging mechanism?
Sesha, I personally think I would not look at gold as an alternative to equity. That's why I said there are two growth assets, real estate and equity compete with each other. Debt and gold, to my mind, compete with each other. Why? Because debt is today in India at 10-year GSEC, Government of India, if you lend, which is risk-free, is about 6.9%. Taxation is marginal tax rate. But gold, if you compare with debt, both on the taxation and the return perspective, is higher. Of course, gold is not as safe as debt, but if you're looking at long term, especially given how rupee depreciates because of the higher interest rate, gold becomes not just a hedge to equity, but also becomes a hedge to currency, which debt is not. So I would not want to compare a straight comparison between gold and equity. I would rather, if I am sitting on 40% debt, which quite a few Indians love debt for no reason, it is like smoking or alcohol. Of course, you enjoy it in debt. You get so much comfort and happiness when you own debt. But in the long run, it will definitely harm you against inflation. So I would say these two assets fight, and I'm sure gold wins over debt any day.
So then, Feroz, what would you recommend to our viewers? How much percentage of portfolio should actually be allocated to commodities, especially gold?
You see, there are different thumb rules because it's a one-to-many communication. You have lakhs of viewers. I would want to say I'll give one thumb rule. Your debt portion should never be greater than twice your gold portion. So if you have 10% in gold, you can have 20% in debt at best. So if the numbers, if you can have your debt plus gold portion together as 50-50.
Feroz, one more follow-up question. Does an SIP in gold or silver like equities make sense or absolutely no?
I personally think anything which is meant for protection need not be staggered because the volatility in gold is lesser than in equity. I would not require. I'm trying to hedge something. So co-hedge karna seems a little double hedging kind of, because SIP helps you gather an asset over longer periods of time because of the price volatility. My risk mitigation tool, I don't want to be so bothered of mitigating risk in a risk adjustment tool.
Well, absolutely, we get that point. But Feroz, as a new investor, if I want to start investing in commodities, how do I really track the commodity market and what are the various factors that drive these moves? How should I assess global trends to actually forecast commodity prices?
See, this is a very complex game. If you're a new investor, you should not do that at all. Right? Forecasting requires so much degree of regression and second degree differential equation to be solved. So forecasting is something which requires a lot of mathematics. If you're a beginner, start with the most conventional commodity, which is there in the futures market. You can use the futures market to track its trends. Anything which is a global commodity like gold, you should look at how the dollar prices have moved. If you just Googled gold dollar prices for the last 80, 100 years would be available on an Excel sheet right on Google. You can understand what are the risks, which is the worst period of gold. If you look at the worst period of gold in dollar terms is from 1980 to 2002, where gold in dollar terms was negative. Understand the worst if you want to understand an asset class. Before investing, it's important to understand the worst situation of anything you invest in. Best situation does not require preparations.
Well, absolutely. It's important to understand the worst before investing in an asset class. Feroz and Anindya, thanks so much for taking your time out and speaking with us here on ET Now.